Something changed in the home insurance industry, and almost no one in the precious metals community is talking about it. Not the dealers, not the stacking forums, not the YouTube channels telling you to buy more silver. Nobody. And if you have a stack sitting in a home safe right now, if you've been buying consistently for the last year or 2 or 5, what I'm about to walk you through could be the most financially relevant thing you hear this month. Not because of what silver is doing, not because of premiums or deficits or paper markets. Because of what happens to your stack if something goes wrong, and you find out too late that your insurance policy has a clause in it that effectively makes your silver invisible. Let me be precise about what I mean. I'm not talking about a fringe scenario. I'm not talking about some obscure loophole that affects a handful of people. I'm talking about a systematic shift in how home insurance companies are categorizing, limiting, and in some cases outright excluding precious metals from standard homeowners and renters policies. A shift that has accelerated over the last 2 to 3 years. A shift that coincides almost exactly with the period when retail silver stacking went from a niche hobby to a mainstream wealth preservation strategy. The people who got into silver early, who have been stacking quietly, methodically for years, many of them built their stack under one set of assumptions about how their home insurance worked. Those assumptions are now wrong, and the gap between what they think is covered and what would actually be paid out in a claim, that gap, for some stackers, is measured in tens of thousands of dollars. Let's get into exactly what happened, why it happened, and what you need to do about it before you need to find out the hard way. First, let's establish how home insurance has historically treated precious metals, because the baseline matters. Under traditional homeowners insurance policies, personal property coverage was relatively broad. You paid your premium, you were covered for theft, fire, certain water damage, and a range of other perils, up to your total personal property limit. If you had $200,000 in personal property coverage, the general idea was that your belongings, your furniture, your electronics, your clothing, your valuables were covered up to that number. Precious metals, coins, and silver bars lived in a gray zone. Most standard policies included them under personal property, but with a sublimit, a cap specifically for certain categories of high-value items. Jewelry was the classic example. Many policies capped jewelry claims at $500 or $2,500, regardless of your total personal property limit. Coins and precious metals often fell into a similar subcategory. The sublimit for coins, banknotes, and precious metals was typically low, $200 to $2,500, depending on the insurer and the policy. But here's the thing. For a long time, this was largely an academic issue. The average homeowner wasn't sitting on 500 ounces of silver. They might have had a few coins, maybe a small inherited collection, and the sublimit, while low, roughly approximated what most people actually had. The system was imprecise, but it wasn't catastrophically wrong for the average policyholder. Then, retail stacking changed the math entirely. Over the last decade, and especially over the last 4 or 5 years, something significant shifted in who buys silver and how much they buy. The combination of post-2020 inflation anxiety, dollar devaluation concerns, and the explosion of online precious metals communities turned silver stacking from a hobbyist pursuit into a serious wealth preservation strategy for a much broader demographic. YouTube channels, Reddit forums, stacking groups on social media. The message spread. Buy physical. Hold it yourself. Don't trust the paper. And people listened. Mint sales data, dealer reports, and retail demand figures all confirmed the same story. The retail buyer base for physical silver expanded dramatically. And critically, the average holding per buyer increased. Someone who started stacking in 2020 with a modest initial purchase has, if they've been consistent, accumulated a position that could easily be worth $10,000, $20,000, $30,000 or more at today's prices, maybe significantly more if they stacked aggressively and silver has moved in their favor. These are not trivial sums. For many middle-class stackers, their silver represents one of the largest single stores of value they own outside of home equity and retirement accounts. And almost all of it is sitting in home safes, gun safes, closets, or other household locations, covered, they assume, by their homeowner's policy. The insurance industry noticed. And they responded the way insurance companies always respond to increased risk concentration. They tightened the terms. Here's what has actually changed in policy language over recent years, and this is the part that should make you put down whatever you're doing and go find your insurance documents right now. Insurers have been quietly revising the definition and sublimit structure for what they call scheduled personal property or specifically identified valuables. The category that historically lumped coins and precious metals in with jewelry and collectibles has been restructured at many major carriers. Several developments have emerged from this restructuring. The sublimits have dropped in real terms. Even where nominal limits haven't changed, silver's spot price has roughly doubled from where it was 4 years ago. A sublimit of $20,500 that felt adequate when silver was $15 an ounce covers far fewer ounces when silver is trading above $30. The math alone has cut effective coverage in half for stackers who haven't updated their policies. Many carriers have introduced explicit exclusions or heavily restricted coverage for bullion specifically. Not coins, not collectibles, bullion. Bars, rounds, and government-issued coins purchased primarily for their metal content rather than numismatic value. If your stack consists primarily of silver rounds, generic bars, or common date government mint coins like American Silver Eagles or Canadian Maple Leafs, there's a real possibility that your carrier's current policy language specifically excludes or severely limits coverage for them. The claims process for precious metals has been quietly made more burdensome. Even where coverage technically exists, carriers have added documentation requirements that most stackers cannot meet retroactively. Purchase receipts, appraisals, photographic inventories, serial number logs. If you've been buying silver over several years from multiple dealers, paying cash at some point, accumulating gradually, the evidentiary trail that an insurer requires to process a claim may simply not exist. The theft category has been narrowed at some carriers. Certain policies now distinguish between burglary with evidence of forced entry and other forms of theft or mysterious disappearance. If your safe is cracked and your silver is gone, but there's no broken window, no kicked-in door, some policies will fight that claim or deny it entirely. And none of this was announced. None of it came with a letter that said, "Attention silver stacker, your coverage has changed." It came buried in policy renewal language, in definitional amendments, in the fine print of endorsement forms that most policyholders never read because they assume their coverage is roughly the same as it was last year. Let me explain why the insurance industry did this, because understanding the incentive is the key to understanding how serious this structural shift is. Insurance companies price risk. That is their entire business model. When the risk profile of a covered category changes meaningfully, they adjust, and the risk profile of precious metals held in residential settings changed dramatically over the stacking boom. More households holding more silver means more theft risk. It means higher claims frequency and higher claims severity when theft occurs. Silver is liquid. It's anonymous. It's easy to sell. A burglar who cracks a safe and finds silver rounds has something they can convert to cash within hours. Unlike stolen electronics, which are trackable, or stolen jewelry, which requires a fence with specific connections, silver moves cleanly through coin shops, pawn shops, and private sales with minimal friction. From an insurer's perspective, silver in a home safe is nearly ideal for theft. High value density, completely liquid, impossible to track, and increasingly common in the residential risk pool. At the same time, home insurance carriers have been under significant pressure from rising claims, costs across all categories, catastrophic weather events, construction cost inflation, supply chain issues driving up repair costs. The industry has been looking for every place it can tighten coverage or reduce exposure. Precious metals were an obvious target. High risk, relatively concentrated among a specific subset of policyholders, and legally adjustable through policy language revision. So they revised it, quietly, incrementally, in ways that most policyholders would never notice unless they had a claim and suddenly discovered that their $25,000 stack was covered for $2,500. Now let's talk about what a claim actually looks like when it goes wrong. Because this is abstract until you imagine sitting across from an insurance adjuster explaining why you had 40 pounds of silver in your basement. Scenario 1. Theft with forced entry. Your home is burglarized, your safe is gone or opened, you file a claim. The adjuster asks for documentation. You provide what you have, maybe some receipts, maybe some bank statements showing purchases from APMEX or SD Bullion. The adjuster reviews your policy. Your personal property limit is $150,000. Sounds fine. Then they point to the sublimit clause. Coins, precious metals, and bullion, coverage limited to $2,000. Your stack is worth $22,000. Your check is for $2,000, minus your deductible. Scenario 2, house fire. Everything is destroyed. Precious metals don't disappear in a fire, but they can melt, deform, and become difficult to identify individually. More importantly, in the chaos of a total loss claim, the burden of proof for every item falls on you. Your insurer will want documentation for every significant item. Can you produce purchase records for every tube of Silver Eagles you bought over 5 years? Every bar? Every round from that local coin show 3 years ago where you paid cash? Without documentation, items simply don't make it into the final settlement. Scenario 3. The mysterious disappearance. Not all theft looks like a movie burglary. Sometimes a trusted person takes something. Sometimes you can't find something and can't account for it. Many policies explicitly exclude mysterious disappearance for high-value items, including precious metals. If your silver is gone and you can't prove how it left, you may be left with nothing regardless of your coverage limits. These are not extreme scenarios. These are the scenarios that real people encounter and real insurance disputes are built around. The gap between what stackers assume their policy covers and what would actually be paid is real, documented, and growing. Here's where the conversation gets more interesting. Because the insurance problem doesn't exist in isolation, it intersects with the broader storage question that serious stackers have to grapple with. And it exposes a tension at the heart of the self-custody philosophy that drives most stacking behavior. The entire appeal of physical silver, the reason people buy it, instead of a silver ETF or a mining stock, is self-custody. You hold it. Nobody can freeze it. Nobody can rehypothecate it. It's yours in a way that a brokerage account balance simply isn't. But self-custody in a home environment creates a concentration of uninsured or underinsured risk that is, depending on your stack size, genuinely dangerous to your financial position. You bought silver to protect your wealth. If your home is robbed and your stack is gone and your insurance pays out $2,000 on a $30,000 loss, silver didn't protect your wealth. It transferred your wealth to whoever took it. The self-custody philosophy is sound, but it requires infrastructure to be sound at scale, and most stackers have not built that infrastructure. They have a safe, sometimes a good one, sometimes not. They have a home policy they've never read carefully, and they have an assumption that these two things together constitute adequate protection. For small stacks, under $5,000, this assumption is probably close enough. For mid-sized to large stacks, $10,000 and above, it is increasingly wrong. And the direction the insurance industry is moving makes it more wrong every year. So what do you actually do about this? Let's be concrete, because vague advice is useless here. The first and most urgent step is to read your current policy. Not the summary, the actual policy document. Find the section on personal property. Find the sublimits schedule. Look for language about coins, bullion, precious metals, numismatic items, or collectibles. Write down what you find. If you can't find it or can't interpret it, call your agent and ask them directly. What is my current coverage for silver bullion stored in my home? Get the answer in writing, not over the phone, in writing. Email them the question. The second step is to understand the gap between your coverage and your actual exposure. Current spot price times your number of ounces. That's your raw exposure. What does your policy actually cover? The difference is your uninsured loss in a worst-case scenario. Look at that number clearly. Don't round it in your head. Don't minimize it. If your stack is worth $18,000 and your sublimit is $2,500, your gap is $1,500 to $500. That is real money you would lose. The third step is to explore your actual options, because they exist and they're more accessible than most stackers realize. Scheduled personal property endorsements, or floaters, are riders you can add to your homeowner's policy that specifically cover listed items at agreed value. This means you list your silver, you agree on a value, and if something happens, you receive that value. These endorsements do require documentation, appraisals for high-value collections, and they do increase your premium. But the premium increase for precious metals coverage is typically modest relative to the value being protected. A few $100s a year to cover $20,000 or $30,000 in silver is a rational expenditure. Specialty precious metals insurance is another option. Companies like Collectibles International, Lloyd's of London Syndicates, and several specialist underwriters offer policies specifically designed for precious metals. These policies often provide broader coverage, fewer exclusions, and claims processes designed around the realities of how people actually accumulate and store physical metal. They understand that you don't have a receipt for every tube of silver eagles. They've built their products around that reality. Home vault storage with an attached policy is a middle option that some stackers with larger positions use. A high-quality safe, properly installed and documented, combined with a specific endorsement from your carrier, can provide meaningful coverage. But the safe has to meet the insurer's specifications. Not every safe qualifies. Know the requirements before you buy. Finally, bank safe deposit boxes are the option many stackers reject on philosophical grounds, because they represent trusted third-party custody. The same argument that drives people to self-custody in the first place makes them uncomfortable with safe deposit boxes. That's a legitimate position. But it's worth understanding that for silver above a certain size of position, professional vault storage or safe deposit box storage, combined with full insurance coverage, may actually provide better overall security than a home safe with inadequate coverage. One more thing, and it's the thing that ties this back to everything happening in the broader silver market right now. The structural tightening of home insurance coverage for precious metals is happening at precisely the moment when the fundamental case for holding silver is becoming more visible to more people. Shanghai premiums are blowing out. 4 consecutive years of supply deficits. Solar demand is accelerating. These are the forces pulling new people into physical silver, and some of those new people, many of them, are going to make the same mistake that experienced stackers have been making for years. They're going to focus entirely on the metal and not at all on the protection structure around the metal. Buy the silver, absolutely. Stack with conviction if that's your assessment of the opportunity, but protect what you're building. The point of physical silver is resilience. It's the asset that survives system failures and currency crises and economic disorder. It should not be the asset that evaporates because of a clause on page 47 of your homeowner's policy. Get informed, get protected, do it before you need to. That's it for today. If this was useful, if it made you go find your insurance documents, share it with someone in your stacking community. This is the conversation that should be happening on every silver forum and every stacking group, and it isn't. Let's change that. I'll see you in the next